Hello, this is Mike Swanson. I run the website WallStreetWindow.com. And the odds are that you're watching this video because you got an email from me telling you that it's up. Now, if you're not on my free email list, go below this video in the description. You'll see a link to join it. Then every single morning before the opening bell, you'll get an email from me, links to my market commentary and the top stories of the day you need to know about. It is your daily morning digest. Now, in this video, I want to talk about the VIX, the volatility index, what it is, how I use it to time bottoms in the market that are buying opportunities, and what it's saying about the market now, because what it's been doing has been very unusual, and you need to know about that. But I got to explain what the VIX is first. So it is the CBOE Volatility Index for options on the S&P 500. And I don't understand the math behind it. You can go look at the mathematical formulas on how it's calculated if you really want to. I'm going to drop a link to this article from Investopedia about the CBOE Volatility Index. It trades, you can buy and sell it, but it's the very reading that's more interesting to me. I don't try to trade it, but it signals fear and complacency in the financial markets. And it's a gauge of real investor sentiment, what traders and investors are really doing with their money, how they're truly responding to the market. And typically on critical, meaningful stock market bottoms, there's panic and fear, and the VIX shows us that, and therefore can say, hey, this is a good, people are panicking too much. The VIX is saying that, this could be the end of a correction. But what it is truly measuring is the premium that traders are paying for options on the S&P 500 for the index itself. And when you may not buy options, I don't trade them very much, but a lot of people do. And there's also people who use options to hedge their positions. So they may get worried about losing money. Instead of selling, they will buy a put option to hedge the position. And the put will go up in value if their position drops. Say they own SPY, the ETF for the S&P 500, they can buy put so that as S&P 500 drops, their put will go up in value. Now, options, though, are priced on two key variables: price, three, the price of the thing, time, how long in the future it will be that the option will expire, and volatility. And volatility is the factor that we want to focus on here. What volatility is the amount of change in price expected over time. And that can change by how quickly a market is moving or how quickly people think a market will move in the future. So what will happen is during a stock market correction, when there's a lot of fear built in and people scramble to hedge, they scramble to buy puts, the volatility premiums will go up. And they can go up so high that they really don't make much sense fundamentally or mathematically. But the people buying them don't really think about that because they're so desperate to hedge that they become willing to pay outrageous prices to do so. And they may not even understand that they're paying outrageous prices to do so, but they are. And those moments coincide with high values in the VIX. So and you can chart out the VIX and it trades in real time. That's why it's so valuable. It's not just some survey of what people say they want to tell you. It's what people are truly doing in the markets and in real time. And here's a chart of the VIX going back to 2003. And again, read the article if you really want the specifics of the calculations and all that. But to simplify things for you, when the VIX gets above 30, that's a sign that people are expecting intense volatility to continue, and they're getting worried about it. It's a sign of stress and fear in the markets. And typically market bottoms will happen with the VIX over 30 at some point. And on the day of a bottom, if there's real intense selling and fear, you can even see the VIX get above 40. And at the moment, in the day of the bottom, often the VIX will go up like 20. And then say the market the Dow goes down 500 and then it's up 500. The VIX will reverse and finish the day in the red. And it's done that multiple times. I've circled some of them on this chart. But there's also been years in which the market didn't correct at all and just went steadily higher week after week after week. And the VIX went lower and lower and lower and lower, even falling below 10. It happened in 2016 to the summer 2018. And I put a rectangle during that period. So you can see that was 2 years of extremely low volatility. One of those years, I don't think the Dow even fell more than 1% in a single day. I think in 2017, that was the case. But even in bull markets, typically there will be a 10% correction. That becomes a buying opportunity when people get fearful and panic and sell on it, coinciding with a spike in the VIX above 30 and sometimes even over 40. It happened in 2014. It happened in 2015. In 2018, the market fell about 20%. The S&P 500 did. In 2012, there's a 10% decline. In 2011, there was one. In 2010, there was one. In 2007, there was one. 2006, there was one. It happened all the time, almost every year. But in 2008, during that bear market, the VIX was trending up, meaning was making higher highs, higher lows, and then when the market crashed, the VIX even went up to 90. When the banking system melted down, a sign of intense fear. In March of 2020, when the S&P fell over 30% with the start of those shutdowns, the VIX almost went to 90. The stock market fell so fast. It was like a crash. It really was a crash. It's unusual situations, these crashes. Most bear markets don't have this mega crash like you saw then. It happens very shortly. But what's happening now this year is very unusual, very unusual. So in one sense, the VIX is making higher lows slowly, something that it did in 2007. That's one similarity I want to draw with it to draw your attention to. But something absolutely amazing, different than I've been trading since the 90s, and the VIX is behaving well. First of all, just remember this: the VIX is one of the most useful tools to use to identify a stock market bottom. I just want to repeat that because it's such a critical point, and I've used it in myself to do so. And the way to do it is look for the VIX to go above 30. The market's correcting 10%, 20%. The VIX is now above 30, and then you have a day in which the VIX goes up 20%. There's a big hard selling in the morning, and then it's a panic washout. And then by the time the day's over, the market's rallying and the VIX has gone down. It's gone up 20% down. So it's had what's called a key reversal day. And again, it's so important. I just want to make sure you understand this. I've circled the days in which that happened. But the market now, the S&P, as I'm doing this video, is down 17%. It was down over 20% at one point. The NASDAQ down more than that. Bitcoin down much more than that. Things that became popular in the past 2 years, such as the ARK ETF, specializing in speculative stocks, getting completely killed. But what's remarkable about this period in the markets is that the VIX, the S&P, as I'm doing this, is below 4,000. It started the year at 4,750. It's essentially 17% decline. But the VIX never had one of these real key reversal days. It never went above 40. It's actually now near 22. There's been no real fear in the options market, despite the fact that the NASDAQ's down over 20%, the S&P currently down 17%. And typically in a stock market correction, they're fast and quick. They may be sharp, but they're fast and quick. They take place over a couple of weeks. The stock market, this has been going on now for 7 months. So this is a market environment, the way the market's been trading this year, a bearish decline over 7 months instead of 6 weeks. Very unusual. The market has never traded like this since I've been in the market in the 90s. And most people haven't been in the market for as long as I have. So we are in a different type of market structure than basically any of us have ever seen. And I don't think people understand that at all. And the VIX is not giving a buy signal despite the decline in the stock market yet. And it's very unusual that it has not done so. In 2007, we had a bear market that lasted from October 2007 to March 2009, and the VIX gave a buy signal in January of 2008, and there was a bear market rally. So the market declined from September, October, November, January, 3 months to kick off that bear market. And there was a buy signal by the VIX in that January in a bear market rally. 3 months. And then there's a buy signal eventually in the fall and so forth. But most bear markets, you see several bear market rallies, several buy signals from the VIX. In the 2000 bear market that ended and it started in March 2000, ended in 2003. There are multiple VIX buy signals. One, the market had a quick drop off the eye, just lasted a few weeks. There's a buy signal in April, and there was a buy signal in January 2001, and there's a buy signal in July 2002. But here we are, 7 months into this bear market, no buy signal yet from the VIX. Very unusual market environment. And there's a lot of expectations among people that are bearish that the stock market, bear market, will accelerate and we'll get a panic washout in the fall. In fact, and that will lead to a great buying opportunity, bear market rally. In fact, at the beginning of the year, my expectation was, okay, we're in a bear market. We're probably going to see things decline. And I was saying last year in the summer that the situation could get bearish because of the market structure, in terms of the market fading, all sorts of different factors. Not really important now, but I thought, okay, we'll probably fall 15% or something into the spring, and we'll get a buy signal from the VIX and a big bear market rally. Didn't happen that way. Didn't happen. So I was surprised, and the market's still trading this way. But there's no guarantee that we'll get a panic washout in the fall. We could, but maybe not. Maybe the market will just keep doing what it's doing now for the rest of the year. There's no way to predict when the real next panic washout buy opportunity will really come. It could be a year from now. It could be in the fall of 2023 instead of the fall of 2022. So how do we deal with that? Well, this is a bear market, so you want to be very cautious, and I think be patient and just let things play out. And what I'm doing is just, I'm not trying to buy the rally we've seen over the past few weeks. I don't really think it's going to last much longer than it has, but I'm just being patient. I'm waiting for that panic washout, whether it comes next month or in the fall or next year. I'm just going to wait. And there's other signs I'll be looking for too to precede it. But that's how I'm dealing with it. I'm not trying to predict the moment ahead of time that it'll come. Will it come this October or will it come next year? I don't know. But I keep my eyes peeled for the time it does come, because when the VIX it'll probably end up going over 40. And when it does get the reversal, it will be a buying opportunity. And the only way to take advantage of it is to watch for it and be prepared to take advantage of it. So if you sit here on full margin and lose a lot of money, you won't be able to buy on the bottom. Cash reserves are key, and I built up even more cash reserves over the past few weeks than I came into the year with. And so this is a very unusual market, and I think we've got to look at past historical cycles of the market to get an idea of what may be actually taking place here. Because so that's when we're going to do some follow-up videos. We're going to look at 1974 and what happened then, because I thought that was a model for what we're going to see this year. And some of the things that happened in 1974 have played out. And the Federal Reserve, in recent statements over the past couple of weeks, has cited the year 1974 as something that it's guiding its own policies. So the Fed is very, got that year in its mind. To you, why is it important? We're going to talk about that. But what about other cycles? We got to draw from past market cycles to try to understand what's going on now, because this is a situation like we have never seen before in our lifetime, and much less someone who started trading 1 or 2 years ago on Robinhood or something. So challenging market, but understanding is, brings knowledge of how to navigate it. So if you like this content and you want to get my next video after that, we're going to dig into these cycles. Click the like button. That way YouTube will know that people find this sort of information valuable. Most of the content on YouTube is about stock picks, predictions, exact predictions. Oh, everything's going to crash next week, or next week's a buy opportunity, or October the 5th is going to be this great day. No, we got to really do harder work than that to understand what's happening. And click subscribe, and then YouTube will send you the next alert. Or click the bell next. Click subscribe, and then click the bell, and then YouTube will send you an alert as soon as my next video is posted for you, and I'll be talking with you later.